I am pleased to be here this morning, although it's almost like the middle of the night for me. Um, but we do think that what we're talking about today is timely and on your minds a lot. So we're looking forward to getting your feedback. There's a couple questions on your table. I don't know if how many have had a chance to look at these questions. The first question reads something like this: If your company faces high demand uncertainty, would you prefer to have more fixed costs or more variable costs in your operating structure? Maybe that's not a fair question today, but I think most of us would believe, and we probably teach, that a company that faces high demand certainty should have more flexibility and have more variable costs in their cost structure. Interestingly, a recent research study looked at the operating leverage for a large sample of companies and found just the opposite. Companies that face higher demand uncertainty tend to have more rigid cost structures, more fixed costs in their cost structure. So why? Well, let's think about fixed costs as owned capacity and variable costs as purchased capacity. What happens when I own capacity and demand is high? I produce. What happens when I purchase capacity and demand is high? Well, congestion occurs because I'm competing with others for that same capacity. So for some companies, the cost of losing sales when demand is high outweighs the cost of bearing those fixed resources when demand is low. Now this example is illustrative of research that tests predictions based on commonly held precepts or accepted models. People often wonder what I do when I'm not teaching. So when I tell them I do accounting research, I get that kind of reaction, right? So I get this, sort of funny look. Well, what's accounting research? And it's a good question. In fact, I really don't do accounting research. I do research about people and how accounting information affects interactions between people. So today we're going to talk about cost behavior. Now, if you look at any managerial accounting textbook, you'll find a section on cost behavior. But costs don't really behave. Costs themselves don't react to stimuli. People behave, and costs are consequences of decisions that people make. In fact, that's what we're going to talk about today: how people behave and how their behavior affects costs. Now, traditional models of cost behavior leave people out. At Haskayne, we like to keep people in the discussion. For instance, the fixed and variable cost model describes how costs change with changes in sales or with changes in volume. Fixed costs stay the same. Variable costs move up and down symmetrically with changes in volume. Okay? So it's a simple model, and it's useful for many purposes. But is it really descriptive of how costs change with changes in volume or changes in sales? In a sense, fixed and variable are extremes. Think about how many of your costs are really truly fixed and how many are truly variable. Now some costs are fixed in the short run, and some costs do move mechanically with sales. But there's a whole world in between of costs that don't behave that way. So for instance, are selling costs fixed or variable? What happens if demand falls? Do you cut advertising, promotional events, sales personnel, travel and entertainment? Well, you probably do, but those things don't happen automatically. People make those decisions to cut those costs or those resources. Another commonly used model of cost behavior that we see in some textbooks is the proportionate cost model. Under the proportionate cost model, we expect that costs will move proportionately with sales. So for instance, if selling general and administrative costs or SG&A costs were 25% of sales this year, well, we expect that they will be 25% of sales next year, whether sales go up or down. Both the fixed and variable cost model and the proportionate cost model share some common features. In a sense, there's no role for managers in these models. We just sort of think that things happen. Both models would predict that cost moves symmetrically with changes in volume. So it doesn't matter whether you're going up or down, costs change in a sense the same way. And this point is sort of related to the first two. Costs in a period depend only on the quantity in that period, not how you got there. In other words, not whether you came up to that level or down to that level. Okay? So this, in a sense, brings us to our second question that's on your tables. So I kind of like this picture because it sort of is descriptive of what you deal with as managers, right? Those sticky costs that you have to work with them. So our analysis was motivated by the observation that costs change when people add or remove resources. When sales increase, resources must be added to accommodate that increase. But when sales decrease, slack resources must be managed. They don't go away by themselves. Managers need to recognize that slack exists and decide whether and when to remove that slack. Now I know that managers are cost conscious, and especially so when sales are down, but there are reasons why managers may not remove slack resources. First, terminating employees, closing facilities, cutting suppliers, those are hard things to do. Managers may feel committed to their employees and to their suppliers. Second, most managers are builders, not dismantlers. They want to build, and that's what they're good at. And third, resource slack today may be valuable in the future. So even if it's costly in the short term, it may be valuable in the longer term. So since our paper was first published in 2003, there have been a number of subsequent studies that have investigated factors that influence cost stickiness. Some have taken a positive approach, that cost stickiness reflects prudent decisions by managers who trade off the costs and benefits of slack resources with the adjustment costs of removing and then replacing resources. And we sort of could call this good sticky. And others have taken a more negative approach, that cost stickiness reflects maybe selfish behavior of managers who don't want to see their empire shrink, or who are not vigilant in controlling costs. And we can call this bad sticky. We don't like to get gum on our shoes, do we? So, and evidence is consistent with both of these. Now, remember, it's not costs that behave, it's people that behave. On the good sticky side, we find that cost stickiness increases with managerial optimism, that sales will rebound in the short run. In fact, an interesting study that one of my Haskayne colleagues did finds that cost stickiness is typically high in the first year of sales decline, but that stickiness actually reverses in the second year of sales decline when optimism fades. Research also finds that cost stickiness increases with adjustment costs, such as the costs of terminating and hiring employees. And these results are consistent with prudent economic behavior. On the bad sticky side, we do find that cost stickiness is more pronounced when there's excess cash, when CEOs are more entrenched, and when corporate governance is less effective. So how do we react in a sales downturn? This, of course, depends on the company. It depends on the managers, the nature of the downturn. And we have to keep in mind that the results that we're talking about are average results. For some companies, flexibility and agility are strengths. We have a study. We look at low-cost carriers in the airline industry, such as Southwest or JetBlue or WestJet, versus full-service carriers like Air Canada. And we find that the low service or the low-cost carriers have less cost stickiness than the full-service carriers. So for those companies, that flexibility gives them a competitive edge. On the other hand, we have another study that looks at companies with high levels of customer satisfaction and find that cost stickiness and performance increases with the level of customer satisfaction. In general, companies that follow a product leadership or differentiation strategy have more cost stickiness than companies that are following a cost leadership or low or operating excellence strategy. So why do we find more stickiness with the differentiators? It's because what makes you different is valuable. Those resources that make you different. So here are some questions to think about, especially in times like we are in right now. Do you slash resources? Do you do across-the-board cuts, or do you prune them? Do you look selectively and see where you can make your cuts? How do you build flexibility into your operating structure? What are the trade-offs that you make when you do that? And do financial analysts and investors understand cost stickiness? And we've done some research about that, and we find that maybe they don't. So I have to admit, I'm on the sidelines in this. We think of research, we follow two different paradigms in a sense in the academic world. One paradigm is what we call positive research, where we look at and see how the world works. We ask, well, what happens? And the other is more normative research that sort of prescribes or thinks about how the world should work. Now my research is on the positive side. I can't tell you what to do. I can tell you what we observe, and I hope maybe give you some things to think about. But as I said, I'm on the sidelines, so you and Sherry, you're on the playing field. So I'm going to turn the ball over to Sherry now. So let's ladies and gentlemen, welcome Sherry Brion from in Canada.
Great, thanks, Mark, and thanks to everybody for joining us this morning. So I really related to that shoe that had the big wad of bubble gum stuck to it these days, where you're trying to move forward and you're lifting this leg and trying to move forward, and really what it requires is probably that deliberate action where you actually took your shoe over and scraped that bubble gum off. And it's a little bit of that Mark's talking about, that really in order to deal with things like sticky costs, it really requires a deliberate action and deliberate decision in order to address them. So I'm going to talk a little bit about the business environment that we're all in, and some of the different reactions and decisions that people are making in order to address the sticky costs in our business environment. The importance of strategic direction in order to make sure that you're aligning your cost reductions or changes in costs with the direction that you want to see the company move in. How do you align these cost reductions with your strategy? And basically try to come out of a business environment that we're all dealing with leaner, more focused, and more competitive. So first, there was a little bit of sunshine yesterday as it poked through the clouds relative to seeing oil prices increase a little bit. But I kind of look at it as being just that. The sun came out, but it's not necessarily out forever. And it's really important that when we're in this environment where we're seeing these sustained lower prices, that we start to look at our cost base, we start to look at where value is generated, and what do we need to do in order to move in the right direction. So I go back and say, within Canada, how have we looked at this and how have we responded? A year ago, when we reset our strategy, we spent a lot of time thinking about what we were really good at, where we were going to create the most value, and how did we need to structure our organization in order to deliver that value. So we started at a much higher level relative to looking at our business. At that point in time, we were investing in about 27 different assets. 27 different assets. And we really decided that this focus on everything really wasn't going to deliver the kind of value that we needed to. It didn't have the scale, it didn't have the opportunity to do as much work on some of the asset areas that we really needed to dial back and get focused. So we've gone to about 8 areas at this point in time. And that was a tough decision, and that was a tough dialogue to have with the teams. We had teams deployed on 27 different asset areas. How were you going to basically reshape the company in order to be successful in the strategy that you were going to choose? So that was one thing that we did was, like I say, focus in and get, redeploy resources and reset our organization around the strategy we chose. When we're in this environment where we're seeing sticky costs, Mark talks about fixed and variable. I kind of think that all of our costs should be looked at as variable, because the variable nature really comes down to how you're making decisions around those costs. And to be quite honest, the more critical the resource, the more sticky the cost, the tougher the decision is as to what you're going to do with it. So even things that you would think that are really, quite fixed, whether that be, your rent, or the number of resources that you've got on a certain project, or even the number of asset areas, those are all really variable, because it takes management's decision in order to decide what they're going to do with that cost stickiness, with that capital allocation, and how they're going to organize the organization. So we could talk about fixed and variable, we could talk about sticky costs, but in the end, it really comes down to the decisions that everyone in this room makes around how they're going to address their costs. So one of the things that we've noticed is that everyone recognizes the kind of cost environment or price environment that we're working in and how that's changed. So the first thing is you're asking your employees to probably do more. You're asking your suppliers to look at their cost base and see what they can do relative to lowering it in this lower price environment. And oftentimes, in the discussions that we've been having with our suppliers, it comes down to probably narrowing the number that we're dealing with in order to increase utilization with them. We're relying on a lot of the alliance and joint venture and activity that we've been able to build, and relationship we've been able to build with our suppliers as to how we're going to work with them going forward. A lot depends on your brand and that dealing fairly in this environment, and then ultimately dealing fairly when prices improve. And so, there's an ask, there's a negotiation, there's an alignment with your strategy, making sure you're focused on the areas that are costing you the most. And then, like I say, there's that optimization and allocation of resources. So once we set our strategy and we've looked at our cost base, and we've looked at negotiating with suppliers, we've looked at how do we want to staff things, what we need to do, We also look at other things that are costing us in this environment. And one of the things that we've been working on is new arrangements relative to marketing. So what we found is that the commitments that the company has had to make, whether it be for pipelines, there's often a take or pay commitment that goes with that, or demand charges that go with it. So you don't really want the tail wagging the dog. You may have these demand charges in one area that you're going to have to pay a marketer for whether you produce or not. So you don't necessarily want to direct your resources to that area if it's not the highest opportunity or creating the most value in your company. So that demand charge or that commitment you have on the midstream side or marketing side is really, obligating you or making you think you need to invest in that area in order to deliver on the demand charge. One of the things that we did quite recently is really try to deconstruct that model a little by entering into an arrangement where you share more risk with the midstream marketer. You pay a fee and you work with a fee that looks reasonable, but you don't have a long-term commitment. You don't have a 20-year commitment that you have to basically, kind of reduce your flexibility and agility and feel like you have to keep delivering and producing in that one area. What you do is we've shared it where the construction is going to be the midstream company's capital, and so you don't have capital exposure. We could manage the pace of our opportunity by controlling the pace of development in any one area. And we're away from, like I say, the long-term commitment. So the commitments are costing you money, but we've been able to try to manage some of that. And it doesn't work in every area, but it has worked in one of the areas that we basically constructed this deal. The last thing I really want to talk about is staffing. And one of the ways that we've been able to manage some of our staff levels is that when we sell resources and there's staff associated with it, that staff goes with the resource. The other way is reshaping our organization so that you start to consolidate roles, you start to give people additional opportunities, but all of these are taking tough decisions. When we recast our strategy last year, we reduced our staff by 25%. So even in this $90 world $100 world that we were living, we were already making those changes to our staff levels and complement in order to align the structure with what we wanted to do strategically. Now, as we look at our staff complement, we haven't been hiring. We've got a few areas where they're still undertaking work relative to dispositions that have occurred. And, we'll be looking at, certainly the salary levels and continuing to manage performance. But through this year and through this reshaping of the organization, we have not added back that 25% reduction. In fact, we've probably, exchanged about 500 in resources depending on what properties came and went, and continued to reduce staff complement. You look at the beautiful building, the Bow. Well, we have the head lease on that. We're in there. We've looked at rent. We've looked at what the cost is to move. And when we moved there, we were basically had a range for rent charges that were lower than what we were paying in the 3 or 4 buildings that we were spread out all over town. So there's different avenues that different companies are taking when they look at their staff costs. But it requires a deliberate decision again. You can't just think that these costs fix themselves. You have to have a team of people in your organization who are prepared to look at what can be reduced, what makes sense, where can you preserve value, how can you work with your suppliers in a reasonable way, how can you look at when things improve that maybe you've got some kicker that goes along with that, regardless of the price level that we're working in now, and consolidating your resources around things that matter and things that are going to create value coming out the other side. Companies in here are going to be stretched, I think, in a $50 world. I think we all are stretched in a $50 world. It's that, Mark coined it the management optimism. So it's that optimism and pessimism that's playing into our decision making. And if I said in this room, how many of you think this cycle is going to fix itself or bring yourself back up to, say, $60 by the end of the year, there's going to be a portion of this group that's going to figure that's going to be the case. If I say, is this going to last 2 years, there's going to be another group that's going to figure that's probably the case as well. What it really comes down to is that the kind of decisions that you're making around managing your cost structures really depends on that view of duration, as to how long you think you're going to be in this spot and what are you going to have to do now in order to make sure you come out the other end and be able to compete and be effective. So I appreciate everybody coming out this morning. I couldn't think of a more timely topic in light of what we've been dealing with. And I know as you're huddling around your tables trying to look at where you need to manage your costs, I think you need to also keep that perspective, whether it be an optimism or pessimism, recognizing everyone's going to have a different view in the back of your mind relative to the decisions that you're going to make. Because this industry has been through more than one of these cycles before and will probably go through them again. And I think that's the resiliency and the innovation of the individuals in this room as to how we function when we see this volatility that really speaks to the capability and the strength of the individuals here. So thanks very much.
But I always like to get my questions in first. Okay, so my first question is for Sherry, and I'm sitting there, and like Mark, I'm not in the real world, but I have 2 engineers in my family, so I kind of get these stories, and I can see them sitting there thinking, okay, I've listened to this, and I get it. I get that we really have to be strategic at how we look at our costs. But my question for Sherry is, so I get it, I've got to take it back to my management. How do I convince them that they need to look at it a different way? So that's my question for you, Sherry. What are a few tips in convincing management?
It's kind of funny, I don't know who said it, somebody said never let a crisis go to waste. And certainly we have an opportunity right now to really elevate this dialogue in your organizations around personalize it as to what can I do, what can my team do, what does leadership need to do in this kind of environment in order to, as I say, be successful as things improve. And I think fact is probably everybody is having this dialogue in their organization. And I think that you can take that initiative going back to your teams and having the discussion amongst yourselves as to what can I personally do in order to make sure that I'm behaving responsibly and that I can see what I can contribute to in moving things forward and making sure that costs are managed. And maybe I need to be asking my suppliers, what do we need to do here? Everybody, whether you're in finance to drilling, is working with suppliers. We've hit up our auditors and said, it's a tough environment. Make sure these audit fees are coming in a little lower. So you're remiss if you don't ask. So.
Okay. Mark, my question for you is, you're teaching these young accountants to come through the system. You're teaching them about sticky costs. And one of my takeaways from this was, we get concerned about sticky costs when times are down. But we maybe should be concerned about them even when sales volume are going up. So do you have advice that you give the accounting students? What should they be looking at monitoring for sticky costs?
Good question. Okay, so I think we do, recognize that, business is cyclic, and so you're gonna go through up and down periods. And I think one of the important things too, and it applies differently across industries, is that, cycles could be, macro in the sense that they affect everybody, or micro in the sense that, maybe it's your product that's suffering. And in that case, then it's more a question of what do we do to get back on track. But I think we would hope to encourage our students to, to take that attitude when they're making decisions in a good time, in the good times. That let's think about what these decisions will bind us to, in times when things aren't so good.
Okay. Are there questions from the floor? Has somebody put up their hand?
I was wondering about the relative stickiness of introduction of a new product such as hydrogen for hydrogen fuel cells. The forecast is 6.5 billion kilograms by 2030. And the question is how the rate of stickiness grows in an expanding market like that, and how you manage it, and how it plays out compared to fixed costs.
Wow, tough question. Is that for me or for you? I think, in fact, some of our doctoral students are here today, and that certainly would be an interesting study. One of our students is sort of looking at what happens in different phases of a firm's life cycle. Do we see more stickiness in sort of growth phases than in other phases? And that's a question I don't have the answer to yet, but I think we certainly need to look at that.
Okay.
Quick question for Sherry. This is more on the people side. So I was running a small company through the 08-09 downturn, and looking at trying to retain your top performers. And on a non-insider or named executive officer basis, we had done a reset of stock options to hang on to the top performers. How are you seeing that in this downturn? Are you looking at contemplating that? Obviously, the problem is that the guys that add the most value are clearly going to be the most mobile. And how are you looking at balancing that versus external stakeholders in this topic?
One of the things that we've been talking about is, we had a very good year relative to making the transition in our organization. And most of our employees are on a bonus structure. And so we are looking at the level of bonus, but not necessarily an adjustment of base pay. And then you also have to look at the level of long-term incentives in order to make sure that your staff continues to be available and willing to continue working at your organization. The interesting thing is that when we've had the discussion with our staff, most of them are just happy to have a job. And so with that, the expectations, I think, change as when you're in this kind of environment. And I think that the more people that understand the situation that you're in when these things happen, the better it is, because everybody tends to rally around what needs to happen during those times, and recognizes that if you are making changes, it's because you basically are trying to make sure the company survives and is in good stead coming out of the cycle.
Okay. We have a question.
Hey there. Is it on? Okay. I've heard one executive describe this as, or former executive describe this as a heart attack to the industry, and that the industry needs to get healthier and get lean throughout this downturn and as we move forward. In your opinion, is it possible or pragmatic to remain lean as things get better, or are we constantly committed to this cycle of getting a little chubbier and then heart attack and then get lean and then chubbier and then heart attack and get lean?
I'm not sure I like that analogy.
Maybe better. Unfortunately, that was someone else's analogy that I stole.
Well, from my view, I think that we should always be focused on costs. To a large extent, that's what we did when we reset our strategy and reset what we did, is that we really focused on the organization and dealt with some costs that we felt were in the system that didn't have to be in order to deliver on the value. What happens is that through these cycles, I think it's everyone learns relative to what works and what doesn't with their suppliers and with their vendors and with their staff. And we do tend to repeat that cycle relative to getting chubby and heart attack and go the other way. But I think that if anything, this review of costs, this review of getting more diligent around making sure your invoices are charging you for, what they should and what rates they should, and these are all just good process changes that have to be put in place, and you usually have the resources to put them to work when you do have a down cycle, because you're not spending capital as much. And so you're utilizing your resources probably in looking at ways to do things better, looking at ways to improve processes that maybe had gotten a little clunkier or weren't as diligent as they should be. But it is a commodity business, and we do tend to grow with the price. And we all know we've been through this more than once, and that's exactly what's happened. I hope that through this cycle we just, like I say, get a little bit better relative to being a little more cost focused and being more diligent around taking the waste out of the process, building better relationships with our suppliers, and building better alliances with both our staff and with the people that we work with.
Okay.
Just comment briefly on
Yeah.
that too. There's a study McKinsey did a few years ago that looked at 230 Fortune 500 companies that announced cost reduction programs, and they found that only 10% of those companies were able to sustain those cost reductions over a 3-year period. But they pointed to things that are exactly what Sherry talked about, that if the cost reductions were strategy driven, that made a huge difference, and if they avoided sort of incremental cost cutting or across the board cuts and looked at targeted cuts, that they were more successful.
Yeah, this idea that you take 10% off of everything isn't the way you should be looking. It's incremental, and it really isn't focusing on the areas that probably need to be looked at and need to be focused on, as opposed to just this broad sweep across the board.
Okay, one last question, okay, right here, maybe two. It will be quick, okay, because I want to keep our promise.
Thank you. Sherry, my question is, what's your opinion about the managerial behavior in the short term? For example, in these economic downturns, and they tend to cut into capital investment, but later on the trend I've seen is kind of a historical trend where we have to replace the lost production of that oil and then meet the new demands for oil. So it becomes really expensive to produce that oil that is needed. And the price of the oil tends to go up, so really profits are not that high. Why don't we stick during these times to what we have, the capital investment, if we know it's a short-term downturn?
I think every company is in a different position relative to the liquidity and their ability to either spend through this cycle or what they need to do with their own balance sheets. I mean, it's interesting. Last year, everything we talked about with our investors was around the assets. This year, everything we've been talking about is around our balance sheet. And so some companies are in a better position to basically spend through some of the cycle and keep the capital investment in order to keep the level of supply there. But not every company is. So it's really unique to each areas and their each company's position that they're in. It's interesting because some of the companies have the capacity to spend more. Some of the companies have put in hedge positions, so even though prices have fallen off, they can spend more because they're spending into their hedge. But I mean, the prudency comes with you either spend into your hedge and keep that capital investment happening, or you let the hedge generate the cash and put it on your balance sheet. So there's different options available to companies. It really just depends on what position they're in.
Okay, one very quick question and then.
Thank you. Yeah, I was just wondering whether there's research on, because it seems like the market forgives restructure costs, and you can adjust your EPS, et cetera, for that type of action. So is there research on whether a company makes out better or the market rewards you for doing that type of activity over a long period of time, you know, every 5 years to restructure, bring your costs out, or if it's more, if they reward that you manage it throughout the entire cycle and, you know, up and down cycle. So if you know what I'm getting.
I'm sure there probably is, but I think it's an excellent research opportunity as well. So I hope my students are listening to your question. So.
They'll be talking to you shortly.